Okay, let's dive into this. Here's our syllabus for today. First, we'll cover the bonus share basics. Second, the rules for bonus eligibility. Third, we'll look at standard journal entry procedures. Fourth, step-by-step bonus scenarios. Fifth, we'll do a quick capitalization practice quiz. And finally, we'll wrap up with the final balance. Make sure you're taking mental notes because you'll need those tools for the active recall quiz at the end.
All right, Section 1, the bonus share basics. What exactly is a bonus issue?
So a bonus issue is essentially an issue of additional shares to existing shareholders absolutely free of cost, in proportion to what they already hold. Now, the absolute secret to understanding this entire explainer is the phrase capitalization of profits. When a company issues bonus shares, it is not, I repeat, not raising new funds from the public. There's no new money entering the company's bank account. Instead, the company is just taking its existing accumulated profits, money that could have totally been distributed as cash dividends, and converting those profits directly into paid-up share capital. It's literally like moving money from your left pocket to your right pocket. The total net worth of the company doesn't change by a single cent, but hey, the number of shares in your portfolio goes up.
Moving right along to Section 2, Rules for Bonus Eligibility, the Laws of the Land. So according to the Companies Act, a company can't just print shares out of thin air. They can only issue fully paid-up bonus shares by dipping into 3 highly specific, legally approved buckets. Bucket number 1, free reserves. These are reserves built from genuine realized profits that are otherwise sitting there available for dividend distribution. Bucket number 2, the securities premium account. And bucket number 3, the capital redemption reserve account. If the money isn't sitting securely in one of these 3 buckets, it simply cannot be capitalized into bonus shares. No exceptions.
So the crucial point here is this. While you can absolutely use free reserves, the law strictly and totally prohibits the use of revaluation reserves. Now you might be wondering, why? Well, because a revaluation reserve is created when a company simply revalues its assets. Let's say they decide their real estate is suddenly worth way more on paper. That's an unrealized gain, a notional gain. It is absolutely not actual hard cash profit generated from running the business. Issuing shares against purely paper profits, that's a massive red flag, and the Companies Act completely forbids it.
Furthermore, Section 63 of the Companies Act acts like a super strict VIP bouncer. A company has to pass this 5-step checklist before even a single bonus share is issued. First, the Articles of Association must authorize it. Second, the board has to recommend it and get it officially approved in a general meeting. Third, and honestly this is absolutely crucial for corporate governance, the company cannot have defaulted on interest or principal for its fixed deposits or debt securities. Fourth, it's got to be totally clear on statutory employee dues, things like provident fund and gratuity. I mean, you can't exactly reward shareholders if you aren't even paying your employees, right? And fifth, any outstanding partly paid up shares must be made fully paid up first.
Okay, Section 3, Standard Journal Entry Procedures. Let's visualize the ledger.
So the actual accounting treatment is this beautifully elegant 2-step dance. Let's see how this builds. Step 1 is the sanctioning. We debit, meaning we decrease, our approved buckets. So you're going to see a debit to the capital redemption reserve account, or a debit to the securities premium account, or the general reserve. And then we credit a temporary holding account called the bonus to shareholders account. We've essentially just moved the value out of the reserves. Then, step 2 is the actual issue. We debit that temporary bonus to shareholders account to zero it right back out, and we credit, or increase, the main share capital account. Boom. Just like that, the profits have officially been capitalized.
Now here's a subtle but really vital nuance hidden in the regulations regarding that securities premium bucket. If you're dealing with an unlisted company under the Companies Act, securities premium that was not realized in cash can actually still be used for bonus shares. But if you are a publicly listed company under SEBI's jurisdiction, SEBI demands that the securities premium must have been realized in cash to be eligible. It's a fantastic, advanced distinction to keep in your back pocket.
All right, Section 4, Step-by-Step Bonus Scenarios. Let's look at the Alpha Company example. Time to do some real-world math.
Imagine Alpha Company announces a bonus issue in the ratio of 2 to 3. What does that mean? It means 2 bonus shares for every 3 shares you already hold. So let's look at shareholder X, who currently holds 6,000 shares. Step 1, we identify the existing base, which is 6,000. Step 2, we apply the ratio. The formula here is super simple. You take the existing shares, divide by the held number, and multiply by the bonus number. So 6,000 divided by 3, which gives us 2,000. Multiply that by 2. Step 3, we get our result.
Shareholder X is entitled to exactly 4,000 bonus shares, completely free of charge.
So what is shareholder X's new reality? Well, they had 6,000 shares. They literally just received 4,000 bonus shares. The grand total sitting in their DMAT account is now 10,000 shares. The actual percentage of the company they own hasn't changed a bit, but their absolute share count has expanded beautifully.
Okay, Section 5, Capitalization Practice Quiz. It is active recall time. Let's see what's stuck.
Question 1, pulled straight from our source material. Which of the following cannot be used for the issue of bonus shares as per the Companies Act? Is it the securities premium account, the capital redemption reserve, or something else we discussed that is strictly forbidden? Lock in your answer.
Got it? Yes, the revaluation reserve. Remember our crucial point from earlier? You absolutely cannot issue shares against paper profits. Simply revaluing an asset does not give you the legal right to issue bonus shares.
All right, let's hit question 2. Think back to that super strict VIP Section 63 checklist. The bonus issue is not made unless what specific type of outstanding shares are made fully paid up?
Yep, partly paid shares. And this brilliantly illustrates the whole logic of the Companies Act. I mean, a company cannot be handing out fully paid bonus shares as a free reward if there are existing shareholders who haven't even paid the full amount owed on their current shares. All shares must be fully paid up on the date of allotment before the bonus party can begin.
Finally, Section 6, the final balance. Let's look beyond the math.
I want to leave you with this really thought-provoking paradox from our source notes. We established earlier that a bonus issue does not increase the net worth of the company. No new funds are raised at all. The earnings per share and book value per share actually decrease because that exact same profit is now spread over more shares. And the market price? It adjusts downwards proportionately. Yet, despite the cold hard math telling us that nothing of intrinsic value has changed, the source material explicitly notes that markets usually take the action as a favorable act. Why? Well, because it heavily signals management's confidence in future earnings. It also increases liquidity by making the single share price more affordable for everyday retail investors. It's this fascinating intersection where strict accounting meets human market psychology. Think on that. Keep reviewing your ledger structures, and you'll have absolutely mastered the art of capitalization.